Welcome back to Trading Made Simple. In today's episode, we're diving deep into one of the most crucial aspects of trading, market analysis. Whether you're just starting out or you're an experienced trader looking to refine your skills, understanding market analysis is essential for making informed decisions. It's the foundation of every successful trader strategy. In this episode, we're going to break down two primary types of analysis: technical analysis and fundamental analysis. We'll explore how each works and how you can use both together to enhance your trading strategy. So let's get started. First up is technical analysis, which is essentially the study of price movements and chart patterns. It's based on the premise that historical price action can provide clues about future price movements. Technical analysis is more about how the market behaves than why it behaves that way. It focuses on market trends, patterns, and trading volume. One of the most common tools in technical analysis is the moving average, a fundamental concept that traders use to smooth out price data over a specific period, making it easier to spot trends. There are two main types of moving averages that traders use: the simple moving average and the exponential moving average. Simple moving average is calculated by averaging the closing prices over a certain number of periods. For example, a 50-day SMA averages the closing prices of the last 50 days. The longer the period, the smoother the average, and this is useful for identifying long-term trends. For example, if the price crosses above the 50-day SMA, it may indicate the start of a bullish trend. Exponential moving average, on the other hand, gives more weight to recent prices. It reacts more quickly to price changes, which makes it a more sensitive indicator for a shorter-term trend. Traders often use shorter period EMAs, such as the 9-day or 20-day EMA, to spot short-term reversals or entry points. For example, a crossover over the 9-day EMA above the 20-day EMA can signal a buy opportunity, indicating a short-term bullish trend. Both types of moving averages are also used to identify dynamic support and resistance levels. When the price is trending up, the moving average can act as a support. When the price is trending down, it can act as resistance. Next, let's talk about chart patterns, which are another key element of technical analysis. These are formed by the price movement on a chart and are used to predict future price movements based on historical behavior. Understanding and recognizing patterns can give traders an edge in predicting future market moves. Here are a few common chart patterns. Head and shoulders. This is a reversal pattern that signals a trend reversal. The pattern forms when the price rises, then falls, rises again to form the head, and then falls again, creating two shoulders. A breakdown above the neckline signals a potential trend reversal from the bullish to bearish. For example, if you see a head and shoulders pattern forming on a daily chart, it may indicate a shift from the uptrend to a downtrend, making it a strong signal to sell. Next one, we have double top or double bottom. These are also reversal patterns. A double top occurs when the price reaches a peak, retreats, and then attempts to rise to a similar level again, but fails. It's a signal that the previous uptrend might be coming to an end. On the flip side, a double bottom occurs when price forms two lows at roughly the same level, indicating that a potential reversal from the downward trend to an upward is likely. For example, a double top formation at key resistance can signal a strong opportunity to sell, while a double bottom at support could indicate a buying opportunity. Next, we have triangles: ascending, descending, and symmetrical triangles. These patterns typically indicate continuation as the price contracts into a point before breaking out. Symmetrical triangles usually indicate that the market is uncertain and a breakout can occur in either direction. Ascending triangles suggest that buyers are in control, and descending triangles suggest that sellers are dominant. Now, let's dive deeper into indicators and oscillators, which are mathematical calculations based on price and volume that help provide more context to your trades. They can confirm trends, warn of potential reversals, and indicate whether the market is overbought or oversold. Here are some of the most popular indicators and oscillators. First, we have Relative Strength Index. The RSI is a momentum oscillator that measures the speed and changes of price movements. It oscillates between 0 and 100 and is often used to identify overbought or oversold conditions. RSI above 70 indicates that an asset is overbought, meaning it may be due for a pullback or correction. RSI below 30 suggests that an asset is oversold, meaning it could be due for a rally or reversal. Example, if you're trading a stock and the RSI shows an overbought condition, which is above 70, this could signal that the price has risen too quickly and may soon reverse. Next, we have Moving Average Convergence Divergence, also known as MACD. The MACD is one of the most popular indicators for measuring momentum and trend strength. The MACD consists of two lines. The MACD line, which is the difference between the 12-day and 26-day EMA, and the signal line, 9-day EMA of the MACD line. When the MACD line crosses above the signal line, it generates a bullish signal, which means to buy. When the MACD line crosses below the signal line, it generates a bearish signal, which means to sell. Additionally, the histogram, which is the space between the MACD line and the signal line, provides insights into the strength of the trend. The larger the histogram, the stronger the trend. Next up, the Bollinger Bands. The Bollinger Bands consist of three lines: the middle band, the upper band, and the lower band. The upper and lower bands are set 2 standard deviations away from the middle band. When the price reaches the upper band, it can signal that the market is overbought and a reversal might be coming. When the price touches the lower band, it suggests that the market is oversold and might bounce back up. A key feature of Bollinger Bands is squeeze patterns, where the bands contract, indicating low volatility. A breakout from this squeeze often results in a strong price movement in the direction of the breakout. Now that we've covered technical analysis, let's shift gears and dive into fundamental analysis, which focuses on understanding the economic factors driving market movements. While technical analysis looks at the price action and trends, fundamental analysis looks at the why behind these movements, which could include economic data, news, events, interest rates, corporate earnings, geopolitical events, and much more. Fundamental analysis involves tracking key economic indicators to gauge the strength of an economy and its financial markets. These include gross domestic product, GDP, a measure of a country's economic activity. A strong GDP growth indicates a healthy economy, which can lead to currency appreciation. Interest rates. Central banks control interest rates, which are crucial in determining the cost of borrowing and the attractiveness of a country's currency. Higher interest rates typically strengthen a currency, while lower interest rates may weaken it. Inflation rates. Inflation measures how much price has increased over a period of time. High inflation can erode purchasing power and impact currency levels. Employment reports. Employment data, like the non-farm payrolls in the US, can have a major impact on the currency markets. Strong job growth is generally seen as a sign of economic health, while weak job growth can signal economic problems. Fundamental analysis also includes keeping an eye on geopolitical events, such as elections, trade agreements, or natural disasters. These events can create market uncertainty or shift investor sentiment, which in turn can impact market prices. Combining technical and fundamental analysis. The key is to use both together for confirmation. Technical analysis tells you what is happening in the market, patterns, trends, and signals. Fundamental analysis explains why the market is moving in a particular direction based on economic data, news, and events. For example, if you notice a bullish pattern on the chart, like an upward breakout or a moving average crossover, and then you hear that interest rates are set to rise for that currency, the fundamental analysis supports your technical setup, making it a stronger trade signal. To wrap up, here's a quick recap of the key concepts. Technical analysis. Use moving averages, chart patterns, and indicators, for example RSI and MACD, to analyze price action and identify trends. Fundamental analysis. Track key economic indicators, whether it's GDP, interest rates, or inflation, and monitor geopolitical events for market moving news. Now combine both. Use technical analysis to time your entries and exits, and fundamental analysis to understand the underlying economic factors driving the market movements. And remember, when you're starting out, it's important to practice on a demo account. You can test different strategies without any risk and refine your approach. That's it for today's episode of Trading Made Simple. If you found this episode helpful, be sure to like and subscribe. Stay tuned for our next episode, where we'll dive deeper into some advanced trading tips and strategies. See you then.